At Social Capital, we talk about our mission a lot. And our mission is to advance humanity by solving the world's hardest problems. We do that by scouring the world to find incredibly ambitious people, men and women who are trying to solve great problems in healthcare or education or financial services. And when we find these people, we allocate capital, but we also spend an inordinate amount of time trying to help them. And a large reason that our strategies evolved this way is because of who we are. We actually have very few people who have a traditional financial services background at Social Capital. It's largely product managers, engineers, technologists, and entrepreneurs who've helped build some of the most iconic companies that many of us use every day, like Facebook or Instagram, Twitter, PayPal. And from that set of experiences, what it's allowed us to do is not just work at the best companies of today, but it's allowed us to identify what we think are going to be the best companies of the future. Amazing companies that hopefully we will all own in the public market soon. Companies like Slack, Premise, SurveyMonkey, Greenhouse. And it's not just those logos from which we derive our experience and our perspectives. When you look at third-party measurements now, there's this interesting phenomenon that has happened, which is that the old guard of Silicon Valley has been disrupted. And when you look inside of portfolios and you look at who is generating the value and who is identifying not just one or two interesting companies, but a broad portfolio of companies, there is a new set of players that are emerging. And from our perspective, we don't just take those perspectives and intelligence and intellect and thought and apply it to Series A or Series B investments. We've increasingly started to apply it across the broad spectrum of investment opportunities, whether they're public companies now, private companies, and we are off to a great start. And so it's from this lens that I'd like to talk about something that I think is exceptionally interesting. We believe that there is a multi-trillion-dollar monopoly hiding in front of us in plain sight. Trillion with a T. And when we think about that opportunity, what's incredible to us is it meets the same investment hurdle that we define for a private investment. So when we sit around and we make private market investments, for example, when we invested in the Series A of Slack, $30 million investment, we said, man, this is a company that can be a 10x in 10 years. For the first time in at least our investment horizon, we've found a company that we can say that about in the public markets. And that company is Valiant. Too soon? Too soon. That company is Amazon, everybody. Now, what's interesting about the psychology of investing is that when you see a stock chart like this, the initial implication and the initial reaction is to figure out how does one trim? How does one take risk off? How does one start to monetize and book the profit? My perspective is that this is a story that's just beginning. In fact, we believe, and in our models indicate, that we think that this is a $3 trillion company in the next 10 years, which for all of us in this room is a 24% IRR a year. So how? Well, there are really three critical components to how Amazon builds this kind of value. The first, I think, is extremely well understood, which is the value of their retail business, which we think over the next decade is about $1 trillion. The second is something that we think is actually not as well understood, which is the unbelievable opportunity that AWS represents, which is a $1.5 trillion business, and we'll show you why. And then last is something that we think nobody understands, which is a new insight into how Jeff manages the business and will hopefully allow us to manage our short-term reactions to minimize the volatility of what Amazon does to our books every now and then when they report, which is what we call bets in cash. So let's double-click and go into it. I'm not going to spend a lot of time on the retail business, only because, again, I think it's actually relatively non-controversial. But the retail business is really built on a couple of very simple assumptions. The first, and the most important, is its top-line customer growth. Amazon has about 304 million customers at the end of last year. Our models have it growing by about 10% a year from here on out, to about 788 million global customers. Now, this is against the backdrop of the internet, which will be 3.5 to 4 billion users globally worldwide. And within that global customer cohort, what's really crucial to model accurately is the growth of Amazon Prime. And Amazon Prime has had a phenomenal run to date, but we think it's just beginning. In fact, Jeff says very clearly and unequivocally, he is going to make it functionally irresponsible for any consumer around the world to not be a Prime member. Now, in terms of modeling user growth, I just want to take a step back and talk about an experience that I had at Facebook. When I started at Facebook, we had millions of users, and I put out a plan that said, I'm going to create a growth team, and we're going to go and get to 1 billion users. And I believed in it so much that I actually tied my compensation and equity to that goal. So I think that when we look at a business like this, and we think about modeling growth characteristics, we feel extremely confident in Prime. And the reason why Prime is important is that Prime members disproportionately buy, and disproportionately buy more often than a non-Prime customer, because you don't have to reacquire them, and you get this free shipping. So you can overlay that to understand unit volume growth, meaning buying things on Amazon. Last year, they sold 6 billion things. We believe that this buying of things is going to grow by about 17% a year over the next 10 years. In fact, last quarter, they reported growth of about 25%. So that gets you to about 30 billion units sold. Multiply that by the average GMV, which is about 28 today, growing at inflation. That's $1 trillion of GMV in 10 years. At the EBIT multiple that Walmart trades at, valued at the multiple that Costco trades at today, which again we think is justified because of how important Prime is, you get to about $1 trillion there. AWS. Again, not as well understood as everybody thinks. Look at a company like Twitter. Forget about the business financials. This is a company that has tremendously complicated technical infrastructure. Salesforce has to manage an infrastructure of enterprise SaaS globally all around the world in multiple data centers. Facebook, massive peak concurrency load. This is the blue chip of technical infrastructure. They spend an inordinate amount of money supporting it. If that's the best, the rest will find it economically unfeasible to build their own. In fact, this is an average company in our portfolio, 20 people, hundreds of thousands of revenue. They have the same cost advantage by being on AWS that Facebook has after spending billions of dollars of their own CapEx. In fact, when you survey our portfolio, the best portfolio in Silicon Valley, the fastest growing companies, the most well-run, the highest compounding of revenue, every single one has independently chosen AWS. Every single one. And it's not just all the stuff that's happening today that will move to the cloud and disproportionately to AWS. It's also all the stuff that hasn't been invented, the Snapchats of the world, all of the things that we will not have known are possible, but in a few years we'll be scratching our head, will also move to the cloud. The reason is Amazon is a massive TAM expander. AWS has millions of customers today. Legacy infrastructure companies, we used to think about success in the tens or hundreds of thousands. Said in a different way, if you take nothing else away, AWS is a tax on the internet. It is a tax on innovation, yesterday, today, and tomorrow. Except this tax is owned by a for-profit company that we can all own. In order to understand the value of AWS, one needs to understand what's happening in IT spend today. There is a lot of waste. We think that Jeff is going to completely disrupt this market. There are going to be unbelievable numbers of losers as AWS gets to scale. Why? Since AWS was introduced, more than 50 price decreases. That's almost one every 2 months. Last year alone, more than 700 feature improvements, which was 40% more than the year before that. More capability, more power, lower cost. What do you think it will do? So what he did to retail, he will do to the IT spend. It's also important to note that IT dollars are spent in two really simple ways. The first is stuff that people like I use to experiment on the future, to build products and services that we think can be sold or used by consumers and customers. The second is the few things that actually make it in front of your eyes. Test and dev, production. The reason this distinction is important is that one of every $4 test and dev dollars are absolutely worthless. We build it once, we throw it away. We build it again, we throw it away. This entire cost basis should move to the cloud. It's dramatically cheaper. No CEO or CFO in the world can ever support having on-prem infrastructure for test and dev over the next 10 years. Now, despite that, even if we assume that that budget shrinks dramatically and just 2/3 of it moves to the cloud and 60% of that moves to Amazon, that's a $38 billion EBIT in the 10-year time period. And production, if you take a more conservative approach and say, you know, it's going to take time for the 1,000, the Fortune 500, the Fortune 50, the Fortune 5 to move workloads over to production, and assume only 30% move, well, it's still a huge business, about $92 billion of EBIT at 30% EBIT. Now, Amazon AWS today runs in the mid to high 20s. But again, as the feature improvements continue to scale, they're adding those features at 100% contribution margin, so 30% we think is reasonable. And if you value that business at the basket midpoint multiple of Intel, Oracle, IBM, 3 companies that have zero, little, or mostly negative growth, that's $1.5 trillion business in 10 years. Now, lastly, this is something that is not understood well at all, and I think it behooves us to just focus on this for a second. If you take nothing away from this presentation, please focus on this graph. This is Amazon's reported EBIT relative to what they've reported out. In 2003, at the nadir of the stock after the dot-com boom, bust rather, they had to regain trust with Wall Street. What did they do? They reported max profitability, 5% EBIT margins. In 2006, they got cute. They took some money, they invested in AWS and Prime. They got their hand slapped. They took a step back. Then the financial crisis hit. What did they do? They reverted back to max profitability. So we think this 5% EBIT margin is the actual natural steady state profitability of the business. And so when you look at the reported EBIT, we should not think that the business is unprofitable. We think that what Jeff does is harvest this cash and invest it in the business. And when you add that up, that's $18 billion of investment that he's made on our behalf. Well, you can say, well, wait a minute, he's not an investor. He's not a capital allocator. That is not what somebody should do. What's incredible about this $18 billion, he has now gone and systematically turned every single cost center of Amazon into a long-term source of revenue. If you look at the 2005 income statement as a guide and you look at this P&L, what he has done by 2015 is completely attack every single line item in this P&L. And then if you look at those things and ask yourself a simple question, well, what is the enterprise value of that $18 billion? And if you value Kindle at something like 2 times revenue, if you value Basics the way you value Heinz, or Hanes rather, if you value Amazon payments in a simple framework, Prime the way you'd value Netflix, what you realize is that on our behalf, Jeff has taken that $18 billion and generated more than $200 billion of value. Said in very simple terms, he has compounded that money at 33% for us. That's incredible. So think about the next 10 years. Let's use the last 10 years as a guide. He's reported, on average, 310 basis points. He's invested 190 basis points of what's possible. If you just apply that methodology to the retail business alone, that's $96 billion of investable capital that he will probably not return to us. No matter what we say, no matter how we react to the stock price, he's going to invest it in the business. And he's going to invent things. And now, unlike 10 years ago, those things will have 2 monopoly customers right at the outset. You want to launch a payments business? Guess who your first 2 customers are? Retail and AWS. You want to launch a shipping business? Guess who your first customer is? Retail. You want to launch a processor business to disrupt Intel? Guess who your first customer is? AWS. Trillion-dollar monopolies, king-making, whatever he creates out of this $96 billion. That's $163 billion of incremental value that should accrue to us as shareholders. Now, don't forget all the cash, the 310 basis points. If you add all of that up in retail and add what we think is the forecasted margins on AWS, what you can see is, again, very high level sum of the parts, we start to get to this 10x. Here's the point. I play a lot of poker. I play a lot of high-stakes poker. I think I'm very good at understanding risk-reward, but I think what I'm really good at is reading people. And for the last 3 or 4 years, it has been very difficult for me to actually understand what is happening in Jeff's mind. But I think it's clear. He has been telling us in as many ways as possible that he is building the most durable company in the world. And if you don't believe the actual stylistic statement, what I would tell you is if you read his investor letters, he's been saying the same thing every single year, year in, year out, which is that his process and his strategy is just beginning. We think that this is the most incredible company being built today in the world. It's something that we can all own. It's something that has a fundamental ability to participate in every single facet of internet value creation. If you believe in the internet, you have to believe in Amazon. If you believe in buying things, you have to believe in Amazon. If you believe in consumer consumption, you have to own Amazon. Thanks, everybody.